September 16, 1992. A 62-year-old investor sits in his London office, watching screens flash red across Britain's financial markets. By day's end, he'll have made $1 billion, 0 cents, in a single trade. But here's the twist. He didn't break the Bank of England through superior analysis or inside information. He did it by understanding a psychological principle that most traders have never even heard of. This is George Soros, the man who doesn't just predict markets. He predicts how other people will react to markets reacting to other people. Confused? Good. That confusion is exactly what made him $40 billion, 0 cents. Most traders analyze companies, study charts, crunch numbers. Soros does something completely different. He studies the psychology of markets themselves, how beliefs create reality, how reality changes beliefs, and how this feedback loop creates the biggest opportunities in finance. The question, when a stock price rises, why does it rise? Because it's worth more? Wrong. It rises because enough people believe it should rise. And if enough people believe that, it becomes true. This isn't philosophy. It's the billion-dollar psychology principle called reflexivity. Today, I'll show you how Soros weaponized human psychology to create one of history's greatest trading victories. By the end, you'll understand why he says it's not whether you're right or wrong that matters, but how much money you make when you're right and how much you lose when you're wrong. The reflexivity revolution. Let me start with a story that will change how you see every market forever. It's 1987. Soros publishes a book called The Alchemy of Finance. Wall Street laughs. Academic economists ridicule it. Why? Because Soros claims markets aren't rational. They're basically group therapy sessions for millions of people's biases. His big idea? Reflexivity. Markets aren't just passive reflectors of reality. They actively shape reality. Think about it. If everyone believes a company's stock will rise, they buy it. The buying makes the price rise. The rising price makes the company look more valuable. The company can then do things only valuable companies can do. Raise money easily, make acquisitions, hire top talent. The belief becomes reality. But here's where it gets psychological. This process works in reverse too. If everyone believes a currency is weak, they sell it. The selling makes it weaker. The weakness justifies more selling. Eventually, the currency becomes as weak as everyone believed it would be, or weaker. This isn't economics. This is mass psychology. And Soros realized something profound. If you can predict how people's perceptions will change, you can position yourselves before reality catches up. Reading the collective mind. Here's what makes Soros different from every other trader. Most people try to figure out what markets should do. Soros tries to figure out what markets will do based on what people think they should do. It's like playing chess while everyone else plays checkers. Take his most famous trade. In 1992, Britain joined the European exchange rate mechanism. The government had to keep the pound within certain ranges against other European currencies. But Soros saw something others missed. A psychological trap. The British pound was overvalued. Everyone knew it, but no one wanted to say it. The government kept defending the currency publicly, while probably knowing privately it was unsustainable. This created what Soros calls a boom-bust sequence, a classic reflexivity pattern. Stage 1, false stability. The government insists the pound is fine. Markets reluctantly agree. Stage 2, growing doubt. Smart money starts questioning the sustainability. Stage 3, the tipping point. When enough people doubt, the doubt becomes self-fulfilling. Soros didn't need to know if the pound was theoretically overvalued. He needed to know when enough people would believe it was overvalued that they'd act on that belief. The billion-dollar psychology play. Now here's where psychology becomes profit. September 1992, Soros makes his move. He doesn't just bet against the pound. He borrows $10 billion, 0 cents, to short it. 10 billion. Most hedge funds had less than that in total assets. But this isn't about the size of the bet. It's about the psychology. Soros understood something fundamental. In reflexive markets, you don't just predict the outcome, you help create it. His massive short position didn't just profit from the pound's fall. It helped cause the pound's fall. Other traders saw Soros, the man who knows, betting against Britain. They joined him. Media reported the selling pressure. Politicians panicked. The Bank of England spent $15 billion, 0 cents, trying to defend the currency. By afternoon, Britain gave up. They raised interest rates from 10% to 12%, then to 15% in a single day. Nothing worked. By evening, they withdrew from the European exchange rate mechanism. The pound crashed. Soros made $1 billion, 0 cents in one day. But here's the beautiful part. He was right not because he predicted the future, but because he understood the psychology that would create the future. The 3 pillars of Soros psychology. Soros operates on 3 psychological principles that most traders completely ignore. First, recognize fallibility. Soros starts every investment by assuming he's wrong. This isn't humility, it's strategy. While other traders fall in love with their positions, Soros stays emotionally detached. He's always ready to change his mind because markets change their minds constantly. Second, understand boom-bust cycles. Every market goes through predictable psychological phases. Initial displacement creates a trend. The trend is reinforced by prevailing bias. Eventually, reality diverges so far from perception that the bias becomes unsustainable. The bust follows. Soros positions himself for these psychological transitions. Third, focus on process over outcome. Soros doesn't care about being right. He cares about the probability of being right and the size of the payoff when he is. This is pure psychology. Removing ego from investing. Here's the scary part. Most traders do the opposite. They hold losing positions, hoping to be proven right. They take small profits on winning trades to feel good about being correct. They're playing for emotional validation, not financial gain. The reflexivity trap. But here's where reflexivity gets dangerous for ordinary investors. In reflexive markets, prices can stay wrong for months or years. The feedback loop between perception and reality can create massive bubbles and crashes. Remember 2008? Housing prices rose because people believed they'd always rise. Banks lent freely because rising prices made borrowers look creditworthy. More lending meant more buyers. More buyers meant higher prices. The belief became reality until it didn't. .com bubble, same thing. Internet stocks rose because people believed the internet changed everything. Rising stocks made internet companies rich. Rich companies expanded aggressively. Expansion justified higher prices until reality intruded. Soros understood something crucial. In the short run, markets are psychology. In the long run, they're economics. The key is spotting when psychology has overrun economics so far that a snapback is inevitable. The modern reflexivity problem. Here's why this matters more than ever today. Social media has turned reflexivity into digital wildfire. Meme stocks, crypto bubbles, ESG investing. They're all reflexivity on steroids. GameStop wasn't about fundamentals. It was pure reflexivity. Retail traders believed they could squeeze shorts. The belief created buying. Buying squeezed shorts. Short squeezes validated the belief. Stock went from $15.00 to $480.00 in weeks. Crypto markets are reflexivity laboratories. Bitcoin rises because people believe it will rise. Rising prices attract institutional adoption. Adoption legitimizes the technology. Legitimacy attracts more investment. Round and round. The difference? Soros would have played both sides, riding the reflexive trend up, then positioning for the inevitable correction down. Most people just ride the elevator until it crashes, building your reflexivity radar. So how do you apply Soros psychology to your own trading? Start by changing how you see markets. Stop asking, "What's this worth?" Start asking, "What do people think this is worth? And how might that change?" Look for divergences between narrative and reality. When everyone believes something that seems obviously true, that's when it becomes dangerous. Consensus isn't comfort, it's complacency. Track social sentiment, not just technical indicators. What are people saying about sectors, stocks, or markets? How has that sentiment changed? Extreme optimism or pessimism often precedes reversals. Most importantly, understand your own reflexivity. Your beliefs about positions affect how you trade them. If you know a stock will recover, you'll hold through devastating losses. If you believe you missed the move, you'll chase tops. Awareness breaks the spell, the ultimate psychology lesson. But here's Soros' deepest insight. Markets aren't efficient information processors. They're efficient emotion processors. Prices reflect not what assets are worth, but what people feel they're worth. And feelings change faster than fundamentals. This is simultaneously liberating and terrifying. Liberating because you don't need to know everything about a company to profit. Terrifying because rational analysis alone won't save you from irrational markets. Soros succeeded because he treated psychology as seriously as analysis. He studied behavioral patterns like a scientist studies lab rats. He positioned for emotional shifts like a meteorologist forecasts storms. The greatest traders don't just read charts. They read minds. Not individual minds, but the collective mood of markets. They understand that in the short run, psychology beats logic every time. The reflexibility reality check. But let's be honest about something. Soros had advantages you don't have. Billion-dollar positions that could influence markets. Prime brokerage relationships, access to central bankers. His psychology was right, but his resources were exceptional for normal investors. The lesson isn't to bet the farm on reflexive patterns. It's to understand them so you don't become their victim. When everyone's bullish, be cautious. When everyone's bearish, look for opportunities. When narratives become religious beliefs, start planning exits. Most importantly, recognize reflexivity in your own psychology. Your positions influence your perceptions, just as market perceptions influence prices. Stay vigilant against your own biases while profiting from everyone else's. Congratulations, George Soros didn't break the Bank of England with superior analysis. He broke it by understanding something profound. In markets, perception shapes reality until reality reshapes perception. His billion-dollar win wasn't just about currency trading. It was about mass psychology trading. The reflexivity principle reveals markets' deepest secret. Prices don't reflect value. They reflect beliefs about value. And beliefs, unlike value, can change overnight. Soros proved that psychology isn't just part of trading. It is trading. Every price move starts in someone's mind before it shows up on a screen. Every bubble begins with a belief. Every crash starts with doubt. Understanding reflexivity won't make you Soros overnight, but it will help you see markets as they really are, not rational systems, but psychological ecosystems where beliefs breed profits and emotions drive economies. What's your biggest reflexivity mistake? That time you held a falling stock because you couldn't accept the loss? Or chased a momentum play because everyone else was making money? Drop it in the comments. Recognizing these patterns is the first step to profiting from them. If this changed how you see markets, hit subscribe. At Behavioral Alpha, we decode the psychology that moves money. Next time, how Charlie Munger's inversion thinking helps avoid the cognitive traps that Soros actually trades. Remember, in markets driven by mass psychology, understanding the masses becomes your edge. The question isn't whether you'll encounter reflexivity in your trading. The question is whether you'll recognize it before it recognizes you.